She's Sheila Patel, Co-Chief Executive Officer at Goldman Sachs Asset Management. Sheila, thanks for joining us today.
Thank you.
And what we've heard out of China overnight is this evidence of these emerging markets deepening their capital markets, and it's going to be further proof that their representation among global indices are just set to increase.
I think absolutely. It's a recognition, I think, by China of their position in the global economy and of their importance to global GDP growth. It's part of a continuing trend we see of countries within the BRICS engaging with the rest of the world and trying to drive global GDP growth to where it needs to be.
It's a slow process, though, isn't it? Because it's not a big leap from China. There's not a lot of transparency, and repatriating funds isn't easy either, is it?
Absolutely. I mean, I think when you look at China and you see how far we've come, there's still a long way to go. But easing quotas, increasing yuan convertibility, all are steps towards a fully transparent, fully accessible marketplace.
What's the best way, Sheila, because I know you've done lots of research, and we're going to dig into this research now, what's the most efficient way to increase our exposure to growth markets like China, like Russia, like so many you can talk about in the context of global equity allocation? What's the most efficient way?
Well, it's an ongoing debate with investors, I think, and certainly emerging markets funds, growth markets funds, focus on things like the BRICS have been the traditional ways that people have tried to gain access. I think as we talk to investors and think about the traditional benchmarks, the ways that people have measured their ability to gain access, there are some things lacking from traditional benchmarks, and that's something we've spent quite a bit of time on.
And there are flaws measuring it in terms of market capitalization, aren't they? Well, what are these flaws?
Well, interestingly, if you look at the traditional benchmark indices that people use, 37% of global GDP growth is represented by growth and emerging markets, yet only 13% of total global market capitalization is represented by these markets. So indices that rely on market cap severely underweight the importance of these markets.
Tell us about Equity 3.0, because it's based on two observations, I know. It's a rules-based approach. Why might this be the most efficient way of realizing growth in these emerging markets?
Well, what has really developed for us as we worked on the Equities 3.0 theme, really based on the demands of clients and their issues and challenges with traditional benchmarks, has evolved an intrinsic value approach that actually has been picked up by S&P and ended up in their Global Intrinsic Value Index, or GIVI. And the approach here is to try to reduce the impact that market cap has and look at the other features that lead to growth and are more representative of proper equity investing.
So has it proven to reduce overall portfolio risk and to improve risk-adjusted returns? Has it actually proven to do that?
The idea really is to reduce volatility, and the way that's accomplished is by using the 10,000 stocks within the S&P BMI index. It's 46 countries, and applying measures of both their future growth potential, discounted earnings, future earnings, and their current value, their current book value. Taking that and also looking country by country at the top market caps and the highest betas, and reducing those. And by reducing those betas, by adjusting for that high volatility component of traditional indices, and by looking at intrinsic value measures, you come together with an index that actually is much more, we think, a balanced way to look and include growth markets in an overall equities allocation.
We were speaking to our guest earlier from BlackRock about the US economy, and he was highlighting the risks that begin at the beginning of next year, specifically when the private sector, the public sector starts to deleverage, and he was worried about this, the tax cuts and the tax hikes and the spending cuts that are going to automatically take place, which amount to 4% of GDP. Is that the big cloud on the horizon going into 2013, and how do we position ourselves ahead of that?
As we look ahead to 2013, I think we remain relatively more positive on the U.S. Certainly what was mentioned are some headwinds, but I think when you look at overall corporate health, when you look at some of the good news that's come out of the U.S. in terms of improving jobs numbers, and you look at the engine that the U.S. economy has traditionally been to GDP growth globally, I think you see a story where we can see a positive 2013, particularly if we also get the kick in from the growth markets. So it's one cloud, but I wouldn't say it's a full rainstorm.
Is the US sort of returning to its old-time role of being the engine then of the global economy, as we're seeing China definitely slow down, and we're probably going to get no growth in the Eurozone at all in 2012?
I think we have to adjust to a world where the U.S. is one of the main engines, but not the singular main engine. And I think we need to look at the growth markets as a whole. I mean, there are 8 countries that already contribute more than 1% each to global GDP growth, and that is set to increase. Over the next 10 years, they'll contribute 60% of the growth of global GDP, or $16 trillion, if current trends continue. Today, they represent 23% of global GDP growth. So the engine that is represented by the rest of the world is certainly as meaningful as the U.S.
So basically, you have to widen your exposure to these emerging markets. That's the bottom line, don't you?
Absolutely, and I think there's a huge dichotomy between the recognition of that intellectually and the action that we've seen on that from investors.
And as we talked about in the last segment, there are better ways than others of achieving that aim, aren't they? Of achieving improved growth and having less volatility and less risk as well.
Absolutely. So we've certainly seen interest in alternative benchmarks, as we were discussing, the GIVI index, that would give investors an ability to move away from traditional market cap-based indices. But I think as well, what we've seen is investors look more broadly as they start to adjust to a broader world horizon and think about things like emerging markets debt, think about their ability to look at individual countries and the opportunities represented by singularly investing in China or India or Brazil. And all of these are emerging trends as people adjust to a new world order in the economy.
Emerging market debt, I mean, many guests like yourself who I've spoken to this year have been going for this emerging market debt. I mean, how long can this run for? Because it seems to be quite an obvious play, high yield, emerging market debt. Does this have much more legs behind it?
Well, I think there are a few things to recognize. First of all, of course, these will be major themes because there's a search for yield. Every single client we have is challenged by the current yield environment. I think, though, secondly, what we have to recognize is that the emerging markets debt story is not just a sovereign story. I think emerging markets corporates are increasingly of interest. I think overall, as we look at exposure to the emerging markets, even among developed countries, corporates, this is a phenomenon that won't go away. So I don't think it's a flash in the pan idea, so to speak. I think emerging markets debt is very much established now as a core part of people's thoughts about fixed income.
What about the European fixed income market, specifically the sovereign debt market, Sheila? How's that looking to you right now?
Well, I think when we look at sovereigns overall, outside of looking at the growth in emerging markets, we see a not very interesting environment. I think from a yield perspective and overall from from a markets perspective, there are better places for clients to find yield. It's still, govies in general are still a core part of people's fixed income investing, but I think that the key drivers of their returns will be from things like European credit, high yield, emerging markets debt.
And what about equities in general? I mean, equities, what are the themes that investors, we've talked about emerging markets, I'm talking about developed markets here. What are the themes investors should be embracing when contemplating their equity market strategy in developed markets right now?
Well, one of the most interesting things we've found is by doing surveys of our investor bases and retail investors around the world, places like Italy, Germany, Japan, Korea, you name it, there's a real dichotomy between the recognition that equities have to be a part of a portfolio and the feeling that investors have about risk post-crisis. There's still a tremendous risk aversion, and there actually is still quite a home bias. So, for example, in Italy, in our survey, more than 50% of those investors recognized that the emerging markets equities world was an important place to invest, but only 5% thought they'd move up their asset allocation outside of Italian equities. Similar story, although not quite as dramatic, in Germany, where almost 80% of investors recognize the importance of growth markets, and especially China, but only 16%.
How do you educate them then to invest outside their home market? How do you make that big change?
I think what one has to do is help show the ways that we can reduce the volatility of those investments and make smart decisions about those investments. So nobody would ever suggest that somebody should move their emerging markets allocation or their growth markets allocation from 5% to 75%. But by looking at benchmarks such as the GIVI benchmark, and by thinking about the asset allocation, say to companies even within your home market that have emerging markets exposure, and many European corporates have tremendous emerging markets exposure in terms of their sales, their revenues, their profitability, you can slowly but surely move investors towards the exposure they need.
Sheila, thank you very much
Thank
for
you very
joining us
much.
today. Sheila Patel, their co-chief executive officer at Goldman Sachs Asset Management.